Sometimes a market sell-off just seems to come out of absolutely nowhere. One minute, the tech market's humming along just fine. The next, this giant tidal wave of selling just hits, wiping out fortunes and leaving investors completely stunned. It started as a tiny tremor in one market, and before you knew it, it became a global earthquake. So the huge question is, what was the trigger? What single event could possibly cause such a widespread, instantaneous panic across the entire globe? Let's get into it. Okay, to really understand what happened here, we have to start right at the epicenter, where the very first signs of trouble appeared and all the chaos really began. And look, this thing didn't just slowly build up. The panic actually ignited thousands of miles away from Wall Street. It slammed the Indian IT market first, with just shocking speed, before that contagion spread all across the globe. So who got hit first? Major Indian IT firms. We saw shares of companies like Persistent Systems and LTI Mindtree just get hammered, tumbling 6 to 7%, boom, right at the opening bell. It was a brutal, immediate reaction. And the scale of this initial shock was just staggering. To put a number on it, over 1.5 lakh crore rupees in value just evaporated from these stocks in a matter of minutes. That's more than 18 billion US dollars gone in about the time it takes to drink a cup of coffee. The global brokerage firm Jefferies had, I think, the perfect description for it. This wasn't some strategic, calculated move. In their words, it was a get-me-out style selling. Pure, unadulterated panic, with investors just mashing the sell button without a second thought. So what was the spark that lit this whole bonfire? Well, the culprit wasn't a central bank announcement or some geopolitical crisis. No, it was a new tool from a single AI company. The company is called Anthropic. Now, you gotta understand they're a little different. Unlike some of the other AI players you hear about who are focused on, consumer chatbots, Anthropic has been laser-focused on the corporate world, building these highly specialized tools for business productivity and automation. And this new tool they released, it's not just some fancy search engine. It reviews incredibly complex legal documents, it drafts briefings, and it automates all that high-value grunt work that's been the bread and butter for lawyers, consultants, and financial analysts for decades. And right here, this is the absolute heart of the matter. This is why everyone panicked. The market's fear suddenly shifted. The story was no longer about AI being a helpful co-pilot. The terror became that AI wouldn't just assist professionals, it would replace them, literally eating into the core revenue streams of entire industries. So how does that happen? How does one tool from one company set off such a massive global chain reaction? Let's really dissect the anatomy of this sell-off. As someone on Bloomberg television put it, the market's immediate gut reaction was just sell now, ask questions later. It was a classic risk-off move where investors just get out first and then try to figure out what the future holds after they've taken their money off the table. And man, the damage was just everywhere. This wasn't contained to one little sector. U.S. software services firm Gartner plunged 21%. Chipmaker AMD fell 16%. Over in Europe, legal publisher RELX dropped 14%. And back in the U.S., financial data firm Equifax and software giant Intuit saw huge double-digit losses. The pain was absolutely everywhere. The shockwave just ripped through this incredibly diverse range of industries. We're talking software as a service companies, information providers, ad agencies, legal publishers. Even private equity firms that had piled into software investments were suddenly under immense pressure. Everyone was scrambling to figure out how exposed they were. And yeah, that same firm, Jefferies, they came up with a suitably dramatic name for it. The SaaS apocalypse. It might sound a little over the top, but it perfectly captured the existential threat that the market suddenly priced into the entire software-as-a-service business model. But all of this brings up a much bigger question, right? Why was the market so fragile in the first place? How could one little announcement cause this much chaos? Well, it turns out the market was already standing on a cliff's edge. As investor Anthony Scaramucci pointed out, you have to look at the context here. The market was already extraordinarily expensive. He called it the second most expensive market in 155 years, just a hair shy of the peak of the dot-com bubble. That's the kind of environment where any little piece of bad news can trigger a massive correction. And the data really backs this claim up. If you look at the Shiller PE ratio, which is a long-term way of looking at valuation, the S&P 500 was trading at a multiple of over 40. To put that in perspective, the historical average is just over 17. So yeah, valuations were stretched to an absolute extreme. And adding to that fragility was concentration. Think about it. Back at the peak of the dot-com bubble, the top 10 stocks made up about 24% of the S&P 500. Today, just the Magnificent Seven tech giants account for nearly 36% of the entire index. When so much of the market's value is tied up in so few names, any shock to tech becomes a shock to the whole market. So you see, this Anthropic news didn't happen in a vacuum. Investors were already nervous. They were watching the Fed, they were worried about unsustainable national debt, and they just had this general feeling that a correction was long overdue. Anthropic just provided the spark. Ultimately, this event wasn't just a one-day panic. It marked a fundamental turning point in how investors are forced to think about technology, about disruption, and, about risk itself. And this captures that shift perfectly. For the past year, the big question on everyone's mind was, who will be the winners of AI? Now, after the Anthropic shock, the question has completely inverted to, who will be the victims of AI? The focus has pivoted from identifying opportunity to identifying vulnerability. And that creates a whole new danger for investors. As analyst Joseph Carlson points out, being a patient, long-term holder is usually a virtue. But that patience can suddenly turn into denial if the fundamental business model of a company you own is being just totally eroded by technology. Simply holding on is no longer a guaranteed strategy. So this has triggered a flight to safety, but it's a new kind of safety. Investors are now actively searching for AI-proof business models. We're talking about companies built on physical infrastructure like Amazon or Costco, payment networks like Visa, or those with irreplaceable specialized hardware like ASML. Businesses that AI can't just easily replicate or disrupt. And all this leaves us with the ultimate question for the future, doesn't it? The Anthropic rout was a massive wake-up call, proving that no industry is safe from the disruptive power of AI. It forces every single one of us to reconsider. In this new age, what does a truly safe investment even look like anymore?